What if I told you the legendary 4-year Bitcoin cycle might be dead? For years, investors rode the same predictable pattern. 3 years of insane gains, followed by a brutal crash where portfolios got wiped out overnight. But this time, something feels different. Bitcoin is hovering around $100,000 while altcoins are crashing. Institutional money is pouring in like never before. And some experts believe we're entering a completely new era for Bitcoin. One where the old rules don't apply anymore. So is the 4-year cycle truly broken? Or are we just witnessing a delayed crash? Let's break it down. And stick around, because by the end of this video, you'll see why Bitcoin's future might look a lot more like gold than crypto. For over a decade, Bitcoin followed a predictable rhythm. Prices skyrocket after each halving event. Greedy investors FOMO in at the top. Then bam, a brutal 80% crash wipes out millions. Rinse and repeat. Simple, right? Well, not anymore. This time, Bitcoin has a $2 trillion market cap and backing from institutional giants like BlackRock. ETFs have pulled in over $40 billion in fresh capital. And some analysts argue that Bitcoin is transitioning into a mature asset class, more stable, less volatile, and no longer following its wild past cycles. So is the 4-year cycle still valid? Or is Bitcoin evolving into something entirely different? Let's dive in. The 4-year cycle explained, and why it worked before. To understand if the cycle is breaking, we first need to understand why it existed in the first place. Bitcoin's price movements have always revolved around one thing: the halving. Every 4 years, Bitcoin's mining rewards get cut in half, reducing the number of new coins entering circulation. Simple supply and demand economics suggest that less supply equals higher prices. And historically, that's exactly what happened. 2012. Halving. Bitcoin surged from $12 to $1,100. 2016 halving. Bitcoin exploded from $650 to $20,000. 2020 halving. Bitcoin soared from $8,000 to $69,000. Each time it played out the same way. Prices rise gradually. FOMO kicks in. Massive crash follows. But now, things are different. Bitcoin has outgrown its old cycles. Back when Bitcoin was a niche asset, it was dominated by retail investors, people like you and me, making emotional, impulsive trades. Now, institutions are in the game. With BlackRock, Fidelity, and major hedge funds pouring billions into Bitcoin ETFs, the landscape is fundamentally different. Matt Haugen, CIO of Bitwise, put it best. Retail traders are speedboats. They move fast, they panic, they FOMO. Institutional investors? They're tankers. Slow, steady, and they don't make sudden moves. This shift means that Bitcoin's volatility could be fading. Instead of wild 80% crashes, we may start seeing shallower corrections, more like gold. The ETF effect. Why the crash might never come. One of the biggest reasons the cycle could be breaking? Spot Bitcoin ETFs. Before ETFs, most people had to buy Bitcoin directly, which meant that during bear markets they panic sold to cut their losses. Now with ETFs, institutional investors buy and hold Bitcoin as a long-term asset. Pension funds, hedge funds, and banks allocate Bitcoin just like they do gold. The supply is getting locked up, reducing the chance of a massive sell-off. And here's the wild part. $40 billion has already flowed into Bitcoin ETFs, and that's just the beginning. If we see trillions more flood in over the next few years, Bitcoin's price cycles could flatten out completely. Bitcoin is decoupling from altcoins. Here's something strange. While Bitcoin is holding steady near 100K, altcoins are crashing left and right. Why? Because Bitcoin is maturing into a different kind of asset. Historically, Bitcoin moved with the rest of crypto. If Bitcoin crashed, altcoins crashed harder. But now, Bitcoin is starting to behave more like a safe haven asset. Think about it. Bitcoin is being treated like digital gold. Institutions are holding, not trading. Meanwhile, altcoins are still highly speculative. This suggests that Bitcoin may be leaving the crypto casino behind and evolving into something much bigger. If you really want to understand what's happening to Bitcoin, you need to look at Carlota Perez's technological surge framework. She explains that new technologies go through 2 major phases. The wild growth phase, explosive, chaotic growth, like Bitcoin's early years. The deployment phase, where the tech becomes mainstream, stable, and widely adopted. If this theory is right, Bitcoin is now entering its deployment phase. It's no longer some fringe experiment, it's becoming a serious global asset. And in this phase, the wild 80% crashes of the past may be over. There's one more reason why the 4-year cycle might be breaking. It's too predictable. If everyone expects Bitcoin to crash every 4 years, what happens? People start front-running the cycle. Instead of waiting for the top, they sell earlier. Instead of panic selling the bottom, they buy earlier. This self-fulfilling behavior could be smoothing out Bitcoin cycles. And if that's the case, we might never see another 80% Bitcoin crash again. So is the 4-year Bitcoin cycle officially dead? Maybe not completely, but it's definitely changing. With institutional money pouring in, Bitcoin ETFs locking up supply, and Bitcoin decoupling from altcoins, the days of wild, predictable cycles may be coming to an end. Instead of massive booms and busts, Bitcoin could become more stable, like gold. And if that's true, the best time to buy Bitcoin might be any time, because the next dip might never come. What do you think? Is Bitcoin still following the 4-year cycle, or is this the beginning of something new? Drop your thoughts in the comments. And if you enjoyed this deep dive, make sure to smash that like button and subscribe for more insights into the future of Bitcoin.